You're listening to the Rite Retirement Show.
70% of people out there listening to the show today are going to need some level of care. It doesn't necessarily mean that 70% are going to end up in a nursing home, but 70% of people will need some assistance out there.
The biggest fear is running out of money for the retiree, but what we see is not enough people spend enough of their money.
Cris prides himself in what matters to you. This is the Rite Retirement Show.
Hello and welcome to the Rite Retirement Show. I'm Luann Fulmer, here today with Graham Bauer. Graham is one of the certified financial planners and financial advisors at WG Financial Group. So, he's always on the show with Cris. Today, Cris is not here. So, Graham, I have you to myself, don't I?
Yep, it's just us today. He left the kids alone at home.
Yes, he did. So I don't know what it's going to be like, but no, we're going to keep up with what we always do. And obviously, Graham's going to give us some really good advice about retirement planning. So let's start off with a phone number. I want you to have this number in your phone. 256-937-2010. This is how you can reach out to the team at WG Financial Group. It is complimentary. Now, we've made it easy because you can also text if you prefer texting. So call or text the word visit to our number 256-937-2010. Remember, it's complimentary. Check us out on Facebook throughout the week. Anything happens in the headlines, Cris will be updating our Facebook page, WG Financial Group 256. Our motto, plan, retire, and play. Boy, we want that for you in retirement. You're going to hear us talking a lot about that. Check us out at wgfinancialgroup.com. That's our website. And remember, this show is available also on Spotify and Apple Podcasts. Just search for the Rite Retirement Show, anywhere you get your podcasts. And Graham, so excited to be here with you today.
Yeah, excited to be back. I'll just say real quick for the listener, just in case anyone's concerned, Cris is definitely not going anywhere off the show. He just couldn't be here today.
Yeah.
So,
right.
We should be back to our regularly scheduled 3 people here next week.
Yeah, I'm glad you mentioned that. Yes, for sure. But
yeah, I know sometimes people, might get occasionally, like I'll listen to a sports show or something, and the main host is out for a day, and I'm like, oh my goodness, is he gone?
Yes.
It's like, oh no, just had something come up. But yeah, doing well. We were talking a little bit pre-show. I'm still a little bit jet lagged. Got back in the country a few days ago and just trying to get back on the right sleep schedule. But pretty much there. I'm sure by the time we record next week, you'll be back to normal.
Yeah, but man, you and Emma had a great vacation in Europe. I am envious. I want to go back. You had some fun.
Yeah, it was a great time, and I get to hear about clients' vacations all the time, and it was nice to be able to experience some of the places. It's actually funny, before we left, so we spent a bulk of the time in Ljubljana, Slovenia, which was just a beautiful city. And like maybe 2 days before we left, I'm doing a review with one of our clients here locally, and we were talking about it a little bit. He's a big Europe traveler, and it turns out he had done almost the same route that we had done, about a couple of years ago. And so he gave us some good recommendations that we had. But I always get to hear about these great Europe vacations from clients, so now I can add a little insight instead of just listening.
Yes, I think that is so cool. Yeah, once you've been there, you can really picture it all in your head. One day I want to go to Israel. I don't think now is the time, but I do want to go there someday because my pastor shows all these beautiful pictures, and it is so cool to see what it's like over there and seeing where Jesus walked, so that's something that I certainly want to do.
Yeah, the history obviously in Israel is pretty incredible, but just everywhere over there, it's just so different. Obviously, we have history here, and I love U.S. history, but it's just not quite as long because the proper U.S. history of the United States only really goes back a couple hundred years, and then there's some before that, obviously. But to see structures that have been up for 1,000 years, 600, 700 years,
amazing.
It's just pretty wild, and definitely a change of pace, and to just be around those type of buildings, different architecture, culture, just really amazing.
Yeah,
place to go.
Fun. So fun. Well, I'm glad you had a nice long vacation, and now you're back, and you're back in the swing of things at WG Financial Group. And today, let's go ahead and get to our federal minute. This is something new that Cris wants to do on our show every week. So what do you have for us?
Yeah, so we had done this a little bit in the past. We wanted to start it up again because obviously, a lot has been going on as federal employees. I think federal employment was probably one of like the least talked about things in the world until a couple months ago. And now you see it in news headlines all the time. And it's become a big topic of conversation, really giving FERS employees the spotlight, for better or for worse for them, I guess. But one thing I wanted to talk about today, and I'll kind of tie into a recent headline that I saw, something I was actually kind of unaware of why I wanted to talk about it, but to just go over the FERS supplement a little bit and kind of the future of, maybe what the outlook is on it, if it's still going to be, around in a couple years. So the FERS supplement, obviously, if you're a federal employee, you have your federal pension, and, that's like, that's your civil service pension. That's the core pension that you get from when you're eligible to retire the rest of your life, if you take survivorship, rest of your spouse's life. For certain federal employees, they also get a supplement, which is really a Social Security supplement. At maximum, that supplement can be received between the ages of 57 if you're eligible to retire by 57 and 62 when your normal Social Security benefit could technically start. Or, the more common scenario you see is someone who has 20 years of service, they retire at 60, they'll get typically a supplement for 2 years to get them to 62, and then that supplement will kind of fall off. Now, one thing I'll be clear on here is the Social Security supplement is still administered through OPM. So it's not through the Social Security Administration. If you were a federal employee and you decided to retire at, 60 with 24 years of service, and you went to Social Security, to SSA, and you were like, hey, can I have my supplement? They would be like, no, you can't. That's not through us. So it's kind of, lumped in with your pension. But it has been, I guess, maybe a bit of a factor in federal employees for a little while deciding when they want to retire. Sometimes if you're eligible to retire, as a federal employee, they do give also certain incentives for working till 62. But, to say, hey, I could get out at 57, I get the FERS supplement for a couple years to bridge the gap, and my pension can, be a pretty healthy bit of income to kind of hold you over until, at least until age 62. So the FERS supplement is on the kind of the chopping block right now, which I learned about from a client. I wasn't actually aware of that, but with the bill going through Congress, the big beautiful bill that passed through the House back on May 22nd, I believe, does have a provision in it to stop the Social Security supplement for federal employees for people retiring after 2028, and then there are some exceptions to it, such as I think it's called a 6C employee, like federal officers and firefighters and things like that. People that do dangerous work, and they have different retirement dates, and their system's a little bit different in general. But that has been kind of, I think, one of the lesser talked about things that has been, in that bill going through. And, in some ways, I kind of think, obviously, it'll affect people who are, 15 years of federal service with the federal government and are like 45 right now. But in some ways, it might be kind of a early retirement incentive for some current federal employees who, will be within that eligibility period before 2028 if it does pass. Because, if you were thinking about going out in 2029, but you might, lose out on the supplement if you don't go out a little earlier, maybe you'd go out a little bit earlier. So I'm curious to see how this shakes up. I mean, I don't think that, before federal employees go out and freak out, I'll actually say that you see a surprisingly few amount of federal employees who are on the supplement just because of the fact that you have to retire a bit earlier to be on it.
Okay.
So I wouldn't say it's something that you see with every employee, but I do think that it's going to, in the future, potentially play a factor on when people kind of are looking into their retirement date. So it's just one of those things that I think if you're a federal employee, you need to kind of keep your eye on, especially if you're a federal employee who is kind of creeping closer to being eligible for retirement and being in that, 57 to 62 kind of age group. So I thought that was an interesting thing. There's a few other changes, to federal employment or federal employment benefits rather in the bill. But that one is, to me, the one that, probably the easiest to explain on air. Some of the other ones have to do with contribution percentages and everything like that. But just something to keep an eye on. And I know it's honestly pretty hard to get good information, I think, for federal employees, just because, the standard deductions and the itemized deductions and the tax rates, all those make federal headlines when a bill like this is going through Congress, but not so much on the things that affect, a smaller group of people, but still a large group of people in the U.S.
Right. So the Senate has a hold of it, and it'll be interesting to see what the changes they make with it, right?
Yeah. I mean, it's possible, that more of this stuff could get cut out when it gets to the Senate. Obviously, not everything that went into the House came out the same. Right. That's usually where those negotiations come in. So, I don't really know what the feeling of senators generally is about it. I mean, the estimate that I saw of, the potential savings for cutting the supplement was like $10 billion over 10 or 15 years. So, I mean, that's a chunk of money, obviously, but, it's not like hundreds of billions of dollars or anything like that. Right. So, it could be one of those smaller items that could end up just kind of saying, let's just keep this. I know there are some lobbying groups for federal employees that are not happy about it, but, generally there are probably some other things they're looking at to get this through, but it'll be interesting to see.
So that's part of your federal minute. Anything more on the big, beautiful bill in itself?
Yeah. So I was out of town while a lot of this got passed. So I've been playing a little bit of catch up.
I bet.
I kept up with some things, but, I tried not to stay too plugged in all the time to everything happening over here. But
you were on vacation, so you need to unplug.
Got to unplug a little bit. And I think my wife would be mad at me if I was just looking, reading articles about the tax code all day. But there are some interesting things in here. Some things that I knew were in it, but some things that did get through the House that I think people would just be interested to know, like, how does this actually affect you? Because some things, that have been talked about, you might not feel like affects you so much. Like one thing I'm not going to talk about too much is the, no tax on cash tips, because there's probably not a majority of our listeners that are people who receive a lot of cash tips. If you're, a salary employee, you probably don't receive any cash tips. So that'd be great for you if you do, but if you don't, probably don't think about that quite as much. So the first thing I would say is that, as people know, the tax brackets would be staying the same percentage wise. So, we'd still have the same 7 tax brackets if it gets through, all of Congress without any changes, being made in the Senate at this point. So, that would keep them for a number of years more, which, as we've talked about before, if that does happen, I think does open up the door, or I guess rather keeps the door open for, some strategic future-minded tax planning. Because to be honest with you, even if taxes stay the same now, I mean, it doesn't look like they're going down. So they stay the same. I don't imagine they will stay the same or go down forever. Now, when will they go up? I have no idea. But, obviously different administrations come through, different members of Congress come through, different things get into play, and usually bills like these last a certain amount of years and then they're kind of revisited. So if they do get renewed, that'll be a good time, as we've talked about, for, things like Roth conversions, things of that sort, to kind of be saying, maybe I should pay a little bit more taxes while the rates are a little lower, and get some money into tax-free status to kind of hedge against that in the future. One thing that I think some people might find interesting is the SALT deduction is going, again, if it passes currently, would be going up from $10,000 to $40,000. The SALT deduction, state and local taxes. So the most common thing you're going to see people deducting on that is their state taxes and their property taxes. Okay. Property taxes are really the big one here. I think that people get frustrated about. It's been capped at $10,000 since 2017. So if you're someone who itemizes, and you have, let's just say, $20,000 of state and local taxes that you have to pay, property taxes, state taxes, all that, you could only deduct $10,000 towards itemization. So for a lot of people, that was kind of a barrier to itemize, as well as the high standard deduction, which obviously has a lot of benefits as well to have a high standard deduction, but that was kind of a barrier. So for people that, have a lot of property and pay a lot of property taxes, pay a lot of state taxes, this might open the door for being able to itemize more in the future. If you have that, as well as some mortgage interest.
Okay, that's good.
And other things of that sort. Mm-hmm. Also, the lifetime gift and estate tax exclusions, which doubled in 2017. They're currently would pretty much stay the same and just keep getting inflation adjusted, at least for the next few years. So I think, again, this is something that, and I might talk about this a little bit later in the show if we have time, probably doesn't affect too many people because it's $15 or $14 million per person right now. So, if you're a married couple, you have to have a net worth over, $28 million in order to be paying these estate taxes and gift taxes.
Right.
So for most people, I'm going to assume most listeners here don't have $28 million.
Not a majority of us. Yeah.
Yeah. So, that's for people that are in that upper echelon, they're probably pretty happy about that if that does go through. But that was one thing that was kind of a topic of conversation, whether that was going to come down. So it looks like that might stay the same as well. And then there were a couple other sort of interesting things that got thrown out. These haven't been added at any point so far, but they've been kind of talked about, really just kind of expanding some of the uses of HSAs and 529 accounts. So, basically kind of expanding like what you could use an HSA for, and also, expanding a little bit of what you could use a 529 account for.
Okay.
So that could be a good thing as well. There's also some, provisions about both spouses, I believe, potentially being able to add and catch up to an HSA. Again, none of this is actually in it right now, but it was things that were kind of tossed around.
Okay.
We love HSAs.
The Senate may put in, is what you're saying?
Yeah, they're under consideration, I guess. Yeah. So I thought those were kind of interesting as well. And then I guess I'll throw out one more because this one will actually probably be interesting to people. There is being proposed also an added standard deduction for seniors, which currently there is an additional standard deduction for seniors. This would just make it up to $4,000. I believe right now it's like $1,600, $1,650, something like that. So it would raise that a little bit, which, you get a little extra standard deduction. Can't really complain about that.
No, that's good.
But one thing, Luann, that wasn't in there that I really honestly just learned, not just learned, but learned when I was reading about it, that I'd kind of thought was in there, but I guess didn't get added, was the no tax on Social Security.
Yeah. So we thought that was in there.
Yeah. So I think there was a big, I was hearing a lot of chatter from clients, other people in the industry, just talking about that quite a lot. So I was surprised to see that didn't get added in there.
Okay.
I guess I should say I wasn't surprised that it didn't make it all the way to passing. I think we said on the show that we didn't think it was going to pass even if it made it in. Okay. But I'm surprised that it wasn't even in the package. So maybe the extra standard deduction was kind of still trying to throw seniors a bone.
A little bone. Yeah.
I know that's less of a bone than...
I'll have to tell my husband that because, just recently we were talking about that. And we really thought that was a thing. So we are wrong. Okay.
Yeah. And I think it's one of those things that, for a lot of seniors, I think would be a great thing. A lot of seniors truthfully don't really pay taxes on their Social Security just because they don't have enough other income. Obviously, Social Security does a lot of work keeping people out of poverty. So for those types of people, they probably wouldn't be paying taxes on it anyways. They don't have other income. But honestly, I think for that, at least in my view, it comes down to the fact that obviously we know Social Security, they have some problems they got to work through on the horizon. And I feel like they're probably not going to be very excited to be cutting sources of revenue for potentially funding Social Security at this point, just with everything in the next few 5 to 10 years that they're going to have to, make some changes to the program, whether that's some tax raises or we've talked about that plenty on the show. But that would be kind of my guess as to why that didn't end up getting on there. Also, it was probably kind of a divisive thing. So you can only get so many things through before, it's always a give and a take thing.
Always a give and a take. Yeah, very much so.
Yeah. So I think for a lot of people, just to kind of summarize this, I guess the good news for most people is not a whole lot is changing in this. A lot of this is just things staying the same.
Oh,
because if a lot of people remember, if nothing was done, then everything reverted back to pre-2017 tax code.
Right.
So this is more of a, in my view, almost more of a renewal than a huge change.
Yeah.
There, like I said, there are some changes. Went over a few changes here, but as far as the actual brackets go, the lifetime gift and estate exclusions, the standard deductions, those are all like the really big items in my view, and those are staying pretty much the same, just kind of getting inflation adjusted every year. So you probably won't feel a massive change, if it gets passed. Which you'll just feel kind of from a tax perspective how it feels now, and you'll have a little bit more time, at least however long it gets renewed for.
We won't have to worry about it,
for at least a couple more years.
It's going to be the end of this year, 2025 , right? Beginning of 2026,
I mean, this was the last year to deal with it.
Mm-hmm.
So it, kind of feels like obviously you had to either get a renewal done or just do nothing. And I would have been very surprised if just nothing was done.
No.
But, obviously it's still got to get through. Would be interested to see what else gets added and changed. But at this point, it'll probably mostly be small things. I would doubt you would see, changes to the brackets happening in Senate or changes to the standard deduction. That seems like the big items will probably be set. And then you might see some smaller things like, when it comes to deductions and credits and things of that sort.
Okay. So I like to hear that things are really just going to kind of stay the same. It's just a continuum of what we had. So love it. That's good. Now, did you want to say anything more on gift taxes, or did you already touch on that enough?
Yeah, I wanted to touch on gift taxes for a minute.
Okay.
Because that was something I mentioned there.
Yeah,
and
you did.
I do just see that gift taxes, to me at least, tend to be one of the more misunderstood things in the tax code to, the average person that comes in the office. Because, for example, and Luann, obviously you've been on a lot of shows, so you might not be the right person to ask here, but when you hear like the word, gift tax return, what does that make you think of? That kind of sounds like you're paying taxes, right?
When you say return, yes.
Yeah.
Uh-huh.
Or if you say like annual gift tax exclusion, it kind of sounds like, okay, well, that's the amount that's excluded from taxes.
Right. Yes.
And both of those things are not necessarily true. And so I feel like that is where a lot of the confusion comes in. A common question that I'll get will be something along the lines of, my son and his wife, they're trying to buy their first house. We want to gift them $25,000, but I know that the gift tax exclusion is only like $19,000 this year. So how much are we going to have to pay in gift taxes if we do that? And the answer to that is $0.
Mm-hmm.
You won't have to file a gift tax return. You won't have to pay any gift taxes. So that, obviously it's called gift taxes because at a certain point taxes do kick in, but that limit is very high.
Isn't that interesting? Why is everybody so confused about that?
Well, again, I think it really comes down to the wording, because when you hear tax return, it just sounds like you're paying taxes. So if you gift under, basically what the exclusion is, in a very simple term, it's really kind of the unreportable or non-reportable gift amount. So if I gift anyone, really, well, I shouldn't say anyone, but if I gift a friend, a family member, somebody in my life, $10,000 this year, I do not have to file anything. He does not have to file. He or she does not have to file anything. That is just a transaction between the two of us.
Love it. Okay.
If I gifted someone $50,000, $19,000 of that would be part of the exclusion, wouldn't really have to report that. And then the amount over that, so in this case, $31,000, I would have to file a 709 gift tax return, and it would just be reported.
Okay.
I wouldn't have to pay any taxes on that, but that amount, that $31,000, would count against my lifetime exclusion.
Lifetime.
Yeah.
Aha. Okay.
So what I usually tell people is if they say, oh, do I have to pay gift taxes on this? You can ask, have you gifted more than $28 million in your lifetime if you're married, or, $14 million if you're single? And the answer is 10 out of 10 times no.
No. Yeah.
So if the answer is no, then you don't have to pay any physical taxes on that. You do need to file, a gift tax return, but that's a different thing than actually paying the taxes on it. So for most people, it shouldn't be a barrier at all to gifting family members, unless you're an ultra high net worth person that is likely going to have an estate higher than, the lifetime exclusion. So if you're worth $50 million, then, you need to be more careful about how you gift. And there's other strategies for that. But for your average person, I mean, if you're anywhere between a $1 and, $14 million net worth, for the most part, if you want to give your son, $10,000, $50,000, you're not going to pay taxes on it. He's not going to pay taxes on it. You just might need to file an informational, essentially, return to know what amount is going to count against your exclusion. Right. So, I mean, that is one thing. Keeping the exclusion high is nice is obviously you can give gifts easily, between family and friends, and that's not really an issue. It's more so on reporting. So I think that is one of the major things that people just get nervous about, because they hear the terminology, and I don't know what a better word would be for it.
Right.
To be honest, I mean, I guess maybe we should call it like a gift tax report instead of a gift tax return or something like that.
I like the word report. Yeah.
Yeah. Because it is one of the more confusing things. But at the same time, I think it's important to understand, because, I think one of the best ways to leave an inheritance, if you're someone who wants to leave an inheritance, is to kind of do some of that stuff while you're alive.
Yeah.
We've coined the term here, M&M money, the making memories money.
Making memories, yes.
Yeah. And I know that, for a lot of people, when inheritance is important, you'd probably enjoy seeing your kids or whoever your inheritors are, enjoy some of that while you're still alive. So, I mean, if you, taking people on vacation, buying them a new car, getting the grandkids extra nice Christmas gifts, or paying for college or something like that. All of those types of things, I think, are super, super rewarding. You get to see the gratefulness that, your family has for that. And I'm a big fan of that personally. I know that even with my parents, I've kind of told them, like, hey, as far as like any kind of inheritance, anything in the future goes, if you guys just want to take us on a vacation every now and then, that's the best. We got to go to Colorado with them last year for close to a week. And, it was a great time to just spend time together. And those are the kind of memories that, are really worth more than anything, to be able to do that with family and make those memories. So I know we covered a lot of ground here, a lot of stuff going on with, this bill going through Congress and all of that. And we'll keep talking about it, I'm sure, and updating as things change and if there are things that people need to know. But if you want to come down to the office and sit down with Cris or any of our advisors there, give us a call at 256-937-2010. Again, that's 256-937-2010. You can also use that number to text the word visit. If you're listening on your way to church on Sunday and you want to catch the second half of the show, you can hop over to Spotify or Apple Podcasts. You can find us, I believe, under the Rite Retirement Show, and we have a whole library of episodes, and you'll be able to listen to the end of this one as well.
Are questions about your financial future, such as, have I saved enough? Or will my retirement last, keeping you up at night? Text VISIT to 256-937-2010. That's text VISIT to 256-937-2010 and schedule your consultation today.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
If lingering doubts like, have I saved enough? Or will my retirement funds endure? Are on your mind, it's time to consult with Cris Wallace. Text VISIT to 256-937-2010. That's 256-937-2010 to book your appointment and get the answers you need.
So, Graham, I want to get into making sure that we do have some tax savvy retirement strategies. You know, all of us spend decades diligently saving for retirement. We watch our 401ks grow. We watch those IRAs grow. But here's the important question I think many of us forget to ask is how much of that money is actually going to be taxed? How much am I going to actually get to keep? Because we know Uncle Sam's entitled to a big part of that, especially if you have $1 million in your retirement account. So that's my question right now. Why are tax strategies such a crucial and overlooked aspect of retirement preparation?
I think a big part of it is the fact that, taxes, I would say, are the most complicated part of, both your personal finances just throughout life and retirement, because they kind of touch every other area in some way, shape, or form. I know, when I was going through the CFP curriculum, I'm already forgetting how many sections, 6 or 7 sections, and taxes is one of them, estate planning, there's a bunch of them. And one thing that, the instructor in one of my live review courses said, yeah, there's a designated section for taxes here, but every question has taxes in it in some way, shape, or form. And that was mostly true on a lot of things. And it honestly is true for a lot of questions that you get when you work in the industry, when you have clients and, they come to you and they have questions. A lot of times it is a question that in some way, shape, or form has to do with taxes. Because, like I said, the tax code is very complicated. Analogy I use sometimes, and maybe this isn't the best analogy, but in a lot of ways, I feel like the tax code is kind of like if you took, a sheet of paper and you wrote some information on it and then you just kept copying it over and over and over and over instead of getting a new piece of paper. And by the end, it's gotten really, really muddy. And there's just a lot of inks running on the page and everything. There's the base stuff, and then there's so many things that are added to it. It's constantly changing. It kind of becomes a hodgepodge. Obviously, I'm not implying that the law is gray. I'm just saying there's a lot of info to sift through and it gets kind of muddy. So it's something that you have to think about when you're getting to that stage of life, especially as you're transitioning from the accumulation stage to the distribution stage. So, when you're saving, it's definitely important to think about, but you're mostly thinking about it for the long term, for thinking, okay, well, how I save today really affects me some today, but almost affects me even more in the future than it does today. So, you want to make sure you're making decisions that's not necessarily just helping you today, but, helping you in the future. Because, if you get to retirement and just say all your money is pre-tax, and I'm not saying that that's necessarily the worst thing in the world. There's certainly a lot of people that fall into that category. And, you need to withdraw $3,000 a month, or I guess rather you need $3,000 a month after your other income sources, your Social Security, pension, whatever, to make it work. Well, if all your money's pre-tax, you're going to have to take out a little bit more than $3,000, obviously, to get to that $3,000 net number. So not only is that, just going to be more taxes you're having to pay on that, it's also going to be a higher withdrawal rate off of your money. So, if you needed to withdraw, $5,000 a month, and now you have to withdraw $6,500, because you need to pay $1,500 between, federal and state to get to that 5, then, your withdrawal rate is going up by that percentage depending on your balance. So, I mean, it's something that you have to think about. Like we've said before, I'm not necessarily going to be the person that says, oh, you have $1 million in an IRA. Oh, well, you really only have 700,000 because if you pulled all the money out, you'd pay, blah, 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 blah in taxes because you're not going to pull all the money out in 1 year. And there's ways you can minimize it. But at the same time, you do have to think about it.
Right. And of course, we know our national debt is growing, so we know tax rates could be increased in the future. So the whole thing is you have to be diversified. It's so important with your investments. I want you to tell us exactly, give us an example of what tax diversification is and why it is valuable to retirees.
Yes, I actually saw a case recently, not too long ago, that I thought was pretty much the best example of, tax diversification I had ever seen, where it was someone who had, a very even split of, pre-tax funds in an IRA, Roth IRA funds from contributions and some from a Roth 401k, after-tax funds in a brokerage account, and HSA funds as well that were built up for retirement. And so, I would say that would be kind of like the poster child, the perfect scenario in some regards for, what that looks like. Because if you had that in a perfect world, you have a lot of options for how you want to take income, how you want to, what you want to subject to income taxes when you want to do it. So, I mean, that's kind of on the broad scale, like if you were going to do it perfectly, what it would look like. On a more typical level, I think it really means at least having a few, at least more than one type of retirement savings account that you have to withdraw funds out of, because I've also seen plenty of scenarios where the only thing someone has saved in is an IRA. Again, I'm not saying that's the worst thing in the world, or that, you didn't actually save as much money because you put all of it in an IRA. If you saved well, you saved well. But for example, if you're in that scenario and you have a year where you just have more unexpected expenses than you thought you would have, or you want to make a major purchase, you don't really have any options of how to pay for that rather than, adding that money to your tax return. It could be subjecting your Social Security to higher tax rates, could push you over an IRMA bracket. So there's other, implications that could have, but you really at that point don't really have any other options other than to, just withdraw it. So I think mostly what it affords you is flexibility, being able to have money in a few different buckets. And it just gives you more options because there's, different, I guess, not call them features, but different functions of each account, different things that they can do, different, benefits from a tax perspective and from an investment perspective.
Mm-hmm. Graham, a lot of retirees are surprised to learn that their Social Security benefits might be taxable, and then their Medicare premiums could increase based on that income. Talk about how strategic withdrawals can help minimize these additional costs.
So with Social Security, it's every type of income, I guess, is like this to some extent. But what we talked about in the last section for just a minute, I know that there was obviously some hope that there would be part of this new tax bill, there would be a provision to eliminate tax on Social Security. Doesn't look like that's going to happen at this point. So Social Security, will retain how it's really always been taxed. And the best way that I like to describe Social Security taxation to people is that, on its own, Social Security is not taxable. If Social Security is your only income, you don't have anything else coming in but Social Security, you're not going to pay any taxes on it. It can become taxable based on your other income. So there are thresholds, that you have to get to before your Social Security becomes taxable. A lot of people end up getting to those thresholds because they're not super high, but that is something you have to think about, because the more other income you have, the more Social Security gets subject to tax. So the maximum that can be subjected to tax is 85%. So if you have, I think for a married couple, it's $44,000 modified adjusted gross income, then 40 or 85% of your Social Security will be included in your income and, be taxed at whatever your tax rate is. So, what you do in other places definitely affects that. And that's why, like we were talking about, from a tax diversification standpoint, if every time you need to make a withdrawal, you have to go to a source that's fully taxable or, just fully taxable at ordinary income tax rates, that could potentially have an effect on, your Social Security taxation. It obviously has an effect on your overall taxation. So, strategic withdrawals on a year-over-year basis can help keep you either in maybe the 0-0 bracket, which is actually attainable for more people than you would think, or just at the very least a very low level of taxation on your Social Security benefits.
Okay. What about the qualified Roth withdrawals? Could you talk about that for a moment?
Yeah. So a qualified Roth withdrawal is more or less just a Roth IRA withdrawal after you've met the measures that you have to meet to do so. So those measures are having the account open and funded for 5 years and being over the age of 59 and a half. So we know with Roth IRAs, you can always take out the money that you put in your contribution. So, if you put $5,000 in, you can take that $5,000 out whenever you'd like to. If you put $5,000 in and it grows to $10,000, then you can take the $5,000 out that you put in, but the other $5,000 is going to be subject to the 5-year and 59 and a half rule. So a qualified Roth IRA withdrawal would be one that has met the 5-year rule and the 59 and a half rule, or has some kind of special exemption. There are some other ways that you could, meet that. But if you're doing a qualified Roth IRA withdrawal, it's not going to be added at all to your taxable income. So, using a similar scenario, if someone was, just under the threshold to have any of their Social Security be subject to tax, and, their car broke down and they had to buy a new car, and they were like, I could take $30,000 out of my IRA, or I could take $30,000 out of my Roth IRA. If you did withdraw from your Roth IRA, it wouldn't be added to your income. So you could potentially stay under those thresholds. I'll say the Social Security threshold is fairly low just based on how they calculate modified adjusted gross income. So the IRMA threshold, and I'm sure we'll talk a little bit more about that too, and we've talked about it before, is usually the one that we're thinking a little bit more of because, that one I believe is at like $212,000 for the first bracket on a married couple this year. So it's a much higher threshold, but when you're taking large withdrawals, when you have a lot of income, when you Roth convert, those are the sort of things you think about are, okay, well, if we're just under one of those thresholds to get our Medicare premiums increased, maybe we take withdrawal from over here in this Roth account or this after-tax account, or pay it from cash rather than, tapping into a taxable source. And again, you have to have some level of tax diversification to be able to even, get to make that decision, really.
Okay. So name of our show, the Rite Retirement Show, but we spell it a little bit differently, RITE. And there's a reason for that. And that's because at WG Financial Group, Graham and Chris and the team, they talk about the 4 pillars that you need to have in retirement. And it's, it spells out right, RITE. So Graham, walk us through that. Give us the R, give us the I, give me a T, give me an E. And of course, taxes, I know, is the T. That's a big part of it. But walk us through your whole process, please.
Yeah. So, the R stands for retirement income. The I is investments. The T is taxes, and the E is estate planning. So how we practically use this when you're coming into the office is you actually go through our Rite retirement planning process. What that looks like is, a discovery session, which is essentially where, you'll sit down with one of our advisors and, we'll talk about your situation and get some specific information. Recently I had somebody ask me a question and, just kind of out more so on the street, not in an office setting. They knew what I did. And I felt like afterwards, I was like, I guess I gave a very general answer to that was probably not very helpful in the scenario. Not that I would give a really specific answer just to, a quick question like that. But, as I thought about it, I was like, those types of questions I can't really answer without knowing a lot about your financial situation, because it really depends. And it might sound like a cop-out answer to people in the moment, but it's really not. We really need to know, information about your income situation, about your tax situation, about how you're invested. All of those things matter tremendously in making recommendations. So that's really what the discovery session is for. It's just to sit down, for us to get to know you, collect the information that we need. From there, we build out our Rite Retirement Card. And this is something we've talked about, quite a bit because it is really kind of how we, quote unquote, score people on, how they're doing towards their retirement or, in their retirement, really on efficiencies. It's not like, are you failing retirement? We're not going to give you an A through an F like maybe a normal report card would, but, kind of saying, are you doing this? Are you doing that? What are your fund fee expenses? Are you making contributions here? Are you making them there? Are you, your legal documents, are they up to date? So that is kind of what's going to be touching all of those 4 sections in the Rite process that we go through to kind of give people just a quick visual of, how you're doing before we jump into some more complex, specific planning. So, that is, our general process following those Rite principles. It became, over the last few years, it's become so ingrained in our business that, it's the show name now and everything as well. But we really believe that it, is a good way to help people, understand too what they need to be doing better. Because sometimes, if you just get too in the weeds and get off on a big tangent, people can kind of get lost and think, well, I don't know what you're talking about anymore. So it's good to try to also be concise and say, hey, these are the things that we need to clean up. These are the efficiencies that are not there. These are the things that are being missed.
Yeah. And it's so easy to understand and grasp that these are the things you need to focus on for retirement because you're going into a brand new journey and you're like, you just get a little nervous and the deer in the headlight look like, oh my gosh, there's so much to think about. But really, those are the main things you are going to focus on as you're heading into retirement. And Cris and Graham and the team at WG Financial Group will make sure that you hit all those pillars and that you have a plan for everything in retirement. And we do want you to take advantage of that, which is why we're here, why we do this show every single weekend. That phone number is 256-937-2010, 256-937-2010. You may call that number or you can text the word visit. We also have that available for you if you prefer texting. Call 256-937-2010 or text the word visit. And remember, check us out at wgfinancialgroup.com. Another thing I want to mention right now are the lunch and learns. This is something that you can do if you are the owner of a business and you want Cris and the team to come to you, to your employees and talk about your business. They will certainly do that. All you have to do is call that number as well. I do want to make sure I get that in, Graham. So again, that number 256-937-2010. And we thank you so much for joining us today. This is the Rite Retirement Show. I'm Luann Fulmer here with Graham Bauer today. Kind of filling in for Cris as he has the weekend off, which is fine. He needs to do that. So as I mentioned, the prospect of retirement brings, lots of excitement, but then also concern for Americans. We know that building our nest egg is so important, but the way we take out those funds and the potential tax implications of those withdrawals, that can dramatically impact how long your money's going to last. And number one fear of retirees is running out of money. We want to make sure that you do enjoy your retirement. So let's get into that, Graham. Just some specific actions people could take today to create a more tax efficient retirement strategy, please.
Yeah. So, if you're just looking at your situation today, of course, we'd always say go and talk to somebody to get some more specific advice to your individual situation. But I would say that if you're working, I'll start with working people. If you're still working, you got to look at where your income is at this point. And you got to look at how far out you are from retirement. So, if you're an engineer that's been working for 30 years, you're in your mid to late 50s, or thinking about retiring in the next 5 years or so, you're making $200,000 a year, $250,000 a year. Well, you're creeping up there in the tax brackets. You probably should be thinking about how should I save some money on taxes today? Because, in all likelihood, you probably are going to be in a lower tax bracket in retirement, even if rates go up a little bit, because you're in the 24 right now if you're married, and, that could potentially go up in the future in retirement, but you don't know about that at this point. So that's something you got to think about. You got to think, okay, where's my income right now? Where should I be saving to kind of try and get some more of those tax savings today, knowing that I'll probably be pulling out in a lower rate, in just a couple years in the future. If you're, in a lower tax bracket, if you're making $60,000, $70,000, $80,000 a year, and you are either getting a little closer to retirement or even have 10 to 15 years, I think that's when you have to be thinking about hedging against, some future bracket changes and also just long-term growth of the money that you're putting in. So that's at the point where I'd be thinking about, maybe doing a little bit more Roth funds, either in a 401k, Roth IRA, whatever is available to you, to kind of be, diversifying a bit that way and hedging against some of that future growth that you'll have. So it really depends. And then if you're retired, I think that's when you got to start looking at conversions. You got to start looking at, when am I going to take my Social Security? Should I delay it a few years so, it continues to grow while I convert a little bit from my Roth IRA, while I convert a little bit more? Am I charitably inclined? Should I leave a little bit back for QCDs and things like that? Should I be gifting stock? So there are, things that people can actually go out and do today. But I guess I'd be hesitant to give a broad thing that everybody could go out and do today, rather than just say, talk to somebody, sit down and, figure out what's the best direction for you.
Now, I want you to get into the topic of those Roth IRAs and just how people, that could be something that they could do. It could be an optimal conversion strategy for them. Get into that for us, please.
Yeah. So one thing I will say right off the bat, and here is a little tip that, we'll maybe say could go out to anyone that this situation applies to as far as a Roth IRA goes. If you have a Roth 401k, you have a 401k that you're contributing Roth funds into. If you're eligible, it's very good to have a Roth IRA open and funded outside of work as well. So, even if that's just putting $20 in a Roth IRA at, a big institution and just leaving it there, that starts a 5-year clock. So I mentioned earlier in the show that you have the age 59 and a half stipulation. Mm-hmm. And that is, that's the common one. You have that with traditional IRAs as well. That one's not uncommon. You have that with 401ks and everything. And then Roth IRAs have that 5-year stipulation as well. And so that applies to Roth IRAs. Roth 401ks do not count towards that 5 years. So once you have had a Roth IRA on the outside open and funded for 5 years, at that point, once you're past 59 and a half, met the other tests, the withdrawals will be qualified withdrawals. They will be tax-free. So hypothetically speaking, if you had $200,000 in a Roth IRA, a Roth 401k, and you retired, you're 65, and you had never had a Roth IRA before, you could roll out that 200 to a Roth IRA, and the 200 that you rolled still wouldn't be subject to any taxes or penalties, but any of the interest that it earns from that point on is still subject to a 5-year rule. So, I know for a lot of people, you're probably not going to completely empty out the balance in 5 years anyways. But, for people with smaller balances that, maybe you only had 15,000 of Roth IRA funds in your Roth 401k and you rolled that out and it grew to 17 and you wanted to take the whole 17, but you didn't have it funded for 5 years. So it's just an easy thing to kind of avoid if you're someone who, meets that criteria, which isn't everybody, but, they become increasingly popular. Mm-hmm. So I know I kind of went on a separate tangent, I guess, a little bit about that. But in general, Roth IRAs are a great idea if you're eligible, if your adjusted gross income is low enough. There's something that we recommend, the outside Roth IRAs, pretty much everyone does if they're eligible, if they have excess cash available, and there's a million reasons we could get into for that. But I guess that just having one open and funded is just a good tip if you have that 401k situation.
And I will say my husband and I are trying to do that right now as much as we can. You know, we're both 65 and trying to go ahead and fund those, do a lot of conversions before we head into retirement. And then, you know, just thinking about, I'll start taking Social Security at my full retirement age. We better get these done or couldn't it cause higher taxes for us if we're trying to do that at the same time?
Yeah. I mean, if you're, in the situation where you're taking Social Security already and you're Roth converting, which is not uncommon at all, then obviously your Social Security is also, going to be subject to taxation, likely at higher rates, because of the fact that you have all this income coming in from the conversions that you're doing. So, for people with, large balances that are thinking about doing conversions, it makes a lot of sense to say, hey, well, maybe I just defer Social Security even past 67, even to 70, because, past 67, I'm getting 8% growth plus cost of living adjustment, and I'm not paying taxes on it at higher rates. I mean, if you're getting a 2% cost of living adjustment too, you're getting 10% growth on Social Security for a couple years. Yeah, that's not a rate that's easy to get in retirement. So.
Okay, so my final question to you then, this has been a great discussion about taxes. You're very knowledgeable, Graham. Thank you so much. But let's say someone already has a retirement plan in place, but now they're worried that it might not be tax optimized. What could be some elements they should be looking at when they're seeking a professional for guidance? And of course, they can always reach out to you.
Yeah, I'll give one major one, and I think that would be if you were retired today, do you know where you would be taking money from first? And I think if you don't know the answer to that question, then you need to talk to someone. You need to figure out the answer to that question, because that is really, really important. A lot of people don't talk about that. And that is going to be very practical to your day-to-day retirement once you get to that point. So that's kind of a big key one. Thank you, Luann, for being here with me today. I know it's a little bit different for the listeners. Again, Chris is out on the weekend right now, but he'll be back regularly scheduled next week to be on the show next Saturday. I guess if you miss him too much, you can hop over to the Spotify and Apple Podcasts, go listen to an old show. You can also catch the earlier part of this show if you missed it. I hope everyone has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory services made available through AE Wealth Management, LLC, AEWM. AEWM and WG Financial Group are not affiliated companies. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Financial Group are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only and is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. WG Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial. This radio show is a paid placement.
Wait. Now, wait a little longer. Great. You may have just increased your lifetime income by tens of thousands of dollars. That's how Social Security can work for you. The longer you wait, the more money you may get. Deciding when to start taking your Social Security benefits is one of the most important retirement decisions you'll make. Cris Wallace and the team at WG Financial Group can show you the options and help make the right decision for you and your situation. Call them today, 256-937-2010. You spent decades paying in. Optimize what comes out. Cris Wallace and the WG Financial Group team can help you squeeze every penny out of your Social Security benefits. Don't wait any longer. Call now, 256-937-2010. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm is not affiliated with the U.S. government.